Bank of England have rose the rates again from 3.5 to 4%. What does it mean for the economy? So all of this is putting more pressure on people with mortgages and, of course, businesses struggling to pay their loans back. And this is really reducing the wages through 2023, increasing unemployment and putting undue pressure on a lot of individuals. But why is it happening in the first place? And it really comes down to one word: inflation. So what is inflation? Inflation is essentially when there's too much demand versus supply. So this could be because of dramatically reduced supply or a massively increased demand, or in this case, both. And through COVID, this happened a lot. Obviously, the supply chains were massively impacted, plus the government pumped loads of money into businesses for free, interest-free. And so that built up and spent and spent and spent. And obviously, us at home didn't have really anything to spend money on. And so that flooded the market, massively increased inflation. The target is 2%, by the way. Currently, it's above 10%, and so we need to slow that down. And by one of the biggest monetary policies towards that is by increasing the interest rate, it slows the businesses down, it slows us down, causes a bit of pain, and we hold on to more money. So it gives the chance, businesses the chance to build up their production again and slows down the growth of the market. Short-term pain, long-term gain. Now, believe it or not, this is actually good news, this increase. The reason why is expectations versus reality. So the expectations were a plus 1%. Some people were thinking it would go as high as 1.5% above what we previously had, which was 3.5%. Instead, if we actually look at the reality, it was only plus 0.5%. So the media will go, oh my God, can you believe it? This has a massive impact. Oh my God. And again, that's just propaganda bullshit, isn't it? Because we knew this already. If you go back to some of my videos 6 months ago, 3 months ago, this was already in the pipeline. And by the way, it probably will go up again, which I'll get to in a moment. But why is it important that it's gone up 0.5% instead of the 1 to 1.5%? Well, it's because it curbs inflation a lot quicker. So we are currently at the peak, and the peak is the top line of inflation. Now, of course, this is just a prediction. It could go up, but the Bank of England, the governors, everyone that's well educated is saying we are at that peak. And the main thing we're trying to achieve is curbing that inflation to get down. So it's getting from this peak at 10.5%, ideally down to the average, which is 2%, which is what we really are targeting. So again, I just really want to say, I know it's not a good thing for us short term of why it's going up, but it does help. So the first thing we're looking at is the predicted economic output. And I put econ output on there for short. The economic output is what the country is producing and getting out there. Now, one of the things that's impacted this so much more than anyone could have predicted, or although some people did, is Brexit. Brexit had so much more impact on the economic output of the country than we expected. However, the predictions have got better. We have gone from expecting a 3% drop in economic output to now they are predicting a 1% drop, which is a huge, huge increase in terms of the positivity going from 3% to 1%. That is really, really powerful. The next thing that impacts the predictions is the recession. Now, by the way, no doubt we are going through a recession and will go through a recession. Like, we're already in it. And if you see the papers going, oh my God, this is going to be forget it. Like, it's absolute bullshit. Now, here's what they might have expected before. So here's what's happened in the market over the last couple of years. And what they might have expected is it going like this, and for longer and longer and longer. So what they'll say is deep and long. This was the expectation. This is what people were really worried about. But now, and I'll do this in a different color. So you can sort of see, and this is a little bit of my prediction as well within this, is I actually think it's going to be shorter and narrower. So if we said here is the end of 2023 and there's at the end of 2024, what I actually think we're going to see now is, again, we got the same line here of what we did. I think we're likely to see something like this and then that. And we're going to have a modest increase there. So I think the recession is now only going to take us to the end of Q3, which is the end of September. And then I think we're going to see a modest increase. In fact, what they are predicting in the Bank of England is that by the end of the year, we're going to end up with growth of 0.1%. Now, that is very modest in the grand scheme of things. But what that actually creates is we've got out of a technical recession. Okay, and what that means is by the end of the year, we've actually had overall growth, which is very positive as a prediction for the country. To put all of this into layman terms, it really has two positive outcomes. First of all, the recession is predicted to be nowhere near as bad as they were thinking originally, which means we're going to get back to the country into growth mode, which should then bring down the interest rates. That's number one. Number two is the impact on inflation. Now, the prediction, we're currently at about 10.5%, is that they think by the end of the year, inflation is going to go down to about 3.5% and then 1% in 2024. Now that is absolutely staggering, because if we can tell that off, it means interest rates will start to come down again and stabilize. So what are my predictions? How can you measure this accurately, and who's it impacting the most? So I think the government is slightly over generous with getting to 3.5% inflation. I think what we're going to see is inflation getting to about 4% by the end of 2023. I think inflation might drop between 1.5 and 2.5% in 2024. I think interest rates as a base rate will increase from 4% to, I'd say, 4.75%. And then what I do think is they'll do this over a 3 to 6 month period from now. So it's going to hurt us in the short term. And then I think it's going to tail off a little bit. I think by the end of the year, 2024, maybe we'll see it coming down to about 3.5% and lower. Now, what's worth remembering is a lot of us go, oh my God, oh my God, oh my God, this is huge. These interest rates are killing me. But actually, the interest rates are not a problem. If you look at this graph here, you can see that historically, we are still at a massive all-time low. It's just we've completely flatlined for so many years. But if you look back at 1975 and the 25-year period after that, you can see interest rates in the double figures. And that's just standard. Interest at these levels is actually dramatically low. So who does it actually impact? Well, before that, what's really important is actually being able to measure this, especially if you're a property investor. And the way that we do this to make sure all of our sums are perfect is we use Landlord. They are today's video sponsor. I just want to say a massive thank you to Landlord. If you're not already on Landlord and you're looking to purchase your home or an investment property, then it's always good to do your analysis, and they are making this available completely free. So if you haven't got an account already, it's completely free. They don't charge you to have one. You can analyze all of your deals and predict not only the rental return, but also the growth over time. And you can get access by clicking the link below, fill in your details. It's completely free. So who does this impact and what's the opportunity? Well, people that are going to have the biggest impact is, number one, businesses that have high amount of loans, especially if they're on variable rates. Now, what typically happens is when they're on really low rates, we're talking like the 0.1%, the 0.5%, the crazy low money, is people purchase things based on that interest rate. So imagine I borrowed £1 million in my business at 1%. Well, it's 10 grand a year. And you're thinking 10 grand's a lot of money, but I've got £1 million invested, blah, blah, blah. It's really easy. Fast forward to now, if it's now 5% or 6%, now I'm paying £50,000 to £60,000 on that money. Now, if you've got a business that you're taking £1 million, you should be able to support that, in my opinion. But let's face it, that does put more strain. So then when you've got cost of living crisis, you've got businesses at the height of pressure, you've got employees at the height of pressure, all they want is a bit more money to get by, but the company is paying out a load more money, and so actually the most effective way for companies is doing layoffs and then paying the best performers higher, which is not a nice exercise for a lot of people, hence the predicted unemployment rate. The other people day to day like you and me that are really impacted by isn't for people purchasing new property today because you just adjust your figures. It's actually impacting people coming up to refinances. So if they've purchased property 5 years ago and they did no figures whatsoever at a more reasonable rate, first of all, I wouldn't say stupid, but ill-educated for sure. For sure they should have got better education. You should always do your figures at about 5 or 6% interest rate, even if the interest rates are low, because that's an average rate over the long term. But those people that have purchased property thinking, yay, I'm in a positive cash flow, or if you live there, I can afford this, and now you're coming up to a refinance and it was 1% and now it's 5%, your interest on that's going to go 5x, right? So if you're paying £100 a month at 1%, you're now going to pay £500 a month. And so it's really important to do your figures. Now, that is a shame. I think a lot of people are going to end up needing to sell their property. So it's shit for people in that situation. Now, I don't like to say it, but it also creates an opportunity. Now, what it means is because of the predictions of it being a shallower recession and a shorter recession, it means we need to act quick. Now, a lot of people are going to be struggling. A lot of people are going to need out. Now, that's going to be the case whether you're there or not, but we can actually utilize the opportunity to help the individual. Now, I know that sounds bad, but they're in the situation they're in. You cannot stop that from happening, but you can help the outlet to stop them being repossessed, to help them with the interest rate payments. And one of the ways is obviously buying properties. Now, there's two ways of looking at this. You can either utilize it to get discounts, which, yes, it's cool. You can get a 5-10% discount, but honestly, I just don't focus on discounts myself. I don't really care about it. Me getting 10 or 20 grand off even on a property will not matter in 30 years when the property's doubled and doubled again. I think if you follow that strategy, that's cool for you, but you're probably going to get the weaker areas. Instead, what I look at is getting a great property at a great price that's going to cash flow positively, but more importantly, they're going to be in the best areas that have been selling above market value over the last 2 to 5 years in a hot market. So, take advantage of this to get access to the best properties at a great price and take advantage of the capital growth areas. Hey, that's just my breakdown of what's gone on right now. Let me know what you think by leaving a comment below. I'll try to reply to as many as possible. And if you're new to the channel and you want to find out more about property investment, make sure to hit the subscribe and the notification bell. And of course, if you want to get your data right, make sure to get on Landlord. It's completely free. The link is below, and I'll see you in the next video.